because stock option is a kind of employee compensation, so the company who granted stock option should recognize compensation expense. And let's take a look at what's accounting for the stock option. And this is an example. We assume there are 9,000 stock options were granted to employees, and the bar value of the common stock is $1, and the predetermined exercise price is $10. So during the exercisable period, the employee can exercise the stock option by buying the stock at $10, no matter what the market price going to be. And also the value of stock option $2 is calculated by using Black and Scholes model. So this is another topic of this class. First, on granting date, there's no journal entries, but we know the total value of the stock option is 9,000 multiple 2 is $18,000. Okay. So during the vesting period, the company will recognize the compensation expense. If we assume the vesting period is 3 years, right? So the compensation expense will be recognized evenly in the 3 vesting years. And we know the total value of stock option is $18,000. So for each year, the company will recognize $6,000 compensation expense. Okay, and we debit compensation expense, which reduce retained earnings, and also we use a special additional paid-in capital account to record the total stock option has been granted or left. So this is a journal entry just for one vesting year. So for the total 3 years, you should know the APIC stock option balance is 18,000. Okay, so that's the journal entry made during the vesting period. The next is exercise of an option. So after vesting period, the employees are able to exercise their option. And if we assume there is one option has been exercised, so what happened here? Because option is exercised, the employees are going to buy the stock at $10, and the $10 will be paid to the employer, the company. So the company will receive cash $10 from the employee, and also the additional paid-in capital stock option will be debit too. That means the stock option granted reduced $2, or it also means one stock option has been exercised. And this part is like the company reissue the stock in the open market with the bar value $1, and also 11 is the difference between 12 and 1. Why I marked highlight the treasury stock? Because company usually use their treasury stock to resell the treasury stock as the employees exercise the stock option, because it is easier than the reissue stock by filing to the SEC. So that's one of the reasons why companies maintain a certain amount of treasury stock. It is used for the stock option compensation for employee. And if I assume all the stock option will be exercised, okay, so the cash received will be 9,000 multiple the $10 for each share. Okay, so the company will receive $90,000 from employee, and also at this time the total 18,000 stock options will be debit. Okay, remember here. So if we debit additional paid-in capital stock option, right now the stock option account will be APIC stock option account. Originally it has 18,000. Now it debit 18,000. Okay, so that will be 0. That means all the options granted has been exercised. Okay, so this is the 3 journal entries for the stock option. And also stock option can expire. So if a stock option expired, we are going to debit APIC stock option, right? And also use another special APIC account, special APIC expired option. Okay? So to know more about the expiration of an option, you can check the book or from other resources. The next is a revocation. Okay, option can be revoked. So if an option is revoked, this journal entry is just the reverse journal entry of this one. Okay, so we debit APIC stock option and credit compensation expense. Also, stock option, the employee will make $8 in this case because the market price is 18, right? So for employee to exercise one stock option, the employee will make $8. It pay $10 that will sell at $18 at the current market price, and this $8 will become a tax deduction for the employer, which is good, okay, which will reduce the taxable income. So this is a stock option accounting.